Good day, everyone. I'm Abdul Malik, and throughout this podcast, I will analyze the company's strategic direction, assess the external and internal business environment, evaluate its financial performance, examine its competitive and corporate strategies, and conclude with recommendations and strengthen its future competitive advantage. Let's get into it. Good day, everyone. Picture a small Sri Lankan family business in 1985 going up against multinational tea giants who control the world's blends. 40 years later, that business ships to over 111 countries, and its founder's son still signs the annual report as the chairman and chief executive. That's Dilmah Ceylon Tea Company PLC. I'm Abdul Malik, and throughout this podcast, I will analyze the company's strategic direction, assess the external and internal business environment, evaluate its financial performance, examine its competitive and corporate strategies, and conclude with recommendations and strengthen its future competitive advantage. Everything you'll hear is drawn from Dilmah's own annual report for the financial year 2024-25. Let's get into it. Let's start with who Dilmah actually is. The company was established in 1985 by Merrill J. Fernando, and it pioneered the world's first single origin tea brand. Instead of exporting bulk tea to be blended and packed overseas, Dilmah insisted on growing and picking, processing and packaging every leaf inside Sri Lanka. That one decision is still the backbone of the company's competitive position even 40 years later. Most importantly, Dilmah's success is driven by a clear organizational purpose. The company's philosophy of serving humanity through business demonstrates that profitability alone is not its primary objective. Instead, Dilmah aims to create sustainable value for all stakeholders, employees, tea growers, customers, local communities, and the environment. Their vision speaks about the transformative power of tea and respect for nature. The mission goes further, positively impacting people and nature, built around the phrase you will hear again and again in Dilmah's reporting: businesses as a matter of human service. That's not just marketing language. It shapes real resource allocation decisions, as we'll see in their diversification choices. Now let's zoom out to the industry Dilmah competes in. I'll frame this like a quick pastel scan, though the sharpest picture comes from the Porter's five forces, drawn directly from the company's own strategic disclosures. Competitive rivalry is high. Threat of new entrants is moderate. E-commerce has lowered barriers, but Dilmah's brand heritage, scale, and distribution network protect it. Buyer bargaining power is high. Since retailers and exporters buy demand price, ethics, and health credentials, supply power is moderate. Since tea leaf prices are auction set, the packaging costs stay exposed to global swings, and the threat of substitute is high. Coffee, kombucha, energy drinks, the whole health beverage category is crowding tea shelf space. The operating environment has been genuinely difficult this year too. Exchange rate volatility. Since Dilmah collects revenue in US and Australian dollars, freight disruption from the Red Sea and the regional conflict, and a long-term threat, global beverage giants pushing hard into ready-to-drink tea. There is also a slower-moving environmental risk. Shifting rainfall and rising temperatures threaten yield and quality directly, which is exactly why sustainability shows up in Dilmah's strategy as risk management, not just ethics. So, is this attractive industry? For premium, ethically sourced single origin tea, yes. For commodity tea, not particularly. That segment is being squeezed by discounting and private label competition. Dilmah's entire competitive logic depends on staying in the first category. So how does Dilmah actually compete inside that environment? Their strongest asset is genuinely hard to copy. Full ownership of the value chain from the garden to teacup entirely within Sri Lanka. Not something a competitor can replicate overnight. Layered on top is the brand itself. Dilmah was voted New Zealand's most trusted tea brand for the ninth consecutive year and won the overall market diversified exporter award at Sri Lanka's Presidential Export Awards. Run that through a VRIO lens for a second. Is it valuable, rare, hard to imitate, and is the organization actually built to exploit it? On all four counts, yes. That's not just a nice brand story. It's a textbook source of sustainable competitive advantage. In competitive strategy terms, this is a differentiation strategy, not a low-cost play. Dilmah resisted this pressure to discount that many competitors gave into, backed by real investment. 66.5 million rupees in research and development this year, up 25%, and 35 new product variants launched across 7 ranges aimed at wellness, immunity, and premium artisanal blends. If we look into the SWOT in strategic shorthand, strengths, brand trust, full traceability, single origin authenticity, a genuinely value-driven culture customers respond to. Weaknesses, profitability is thinner than the revenue growth suggests, and the company carries an real currency exposure. Opportunities, premiumization, wellness demand, direct to consumer channels. Threats, RTDT from the multinationals and rising production costs at home. Now, the part I really want to dig into, how Dilmah is executing its corporate strategy and whether its diversification moves actually makes sense. Dilmah organizes its strategy around 4 pillars: global market leadership, operational excellence, empowered workforce, and environment, sustainability, and governance. That's the formal structure. But the more interesting story is what the company has diversified into. Beyond packaged tea, resplendent Ceylon, a portfolio of luxury eco resorts linked through Dylan Fernando's own board involvement. Vitality, a wellness and fitness concept, and the hospitality tea school, training culinary and hospitality professionals worldwide in tea craft. Let's run this through the 3 tests of corporate advantage. Test 1, industry attractiveness. Is premium eco hospitality and wellness tourism attractive? Broadly, yes. Sri Lanka's high-end tourism segment has genuinely growth potential, and it sits right next to the same consumer Dilmah already targets. Test 2, the cost of entry test. This is where Dilmah's approach is genuinely smart. They built organically using existing land, brand equity, and family relationships rather than paying a premium to acquire an unrelated hospitality chain. Test 3, and this is the real test, the better off test. Do tea and hospitality actually perform better together than apart? I'd argue yes. The resorts and the tea school don't just generate separate revenue. They showcase the Dilmah story to exactly the kind of high value, brand loyal customer to the core tea business wants to reach. That's cross business fit through brand sharing, not shared manufacturing, a legitimate if softer synergy. Let's talk numbers because strategy has to show up in the financials or it's just a good story. Group revenue for the year ended March 2025 came in at 21.16 billion rupees, up 14% year on year, driven by export volume growth, pricing discipline, and demand for premium products across key markets. Operating profit more than doubled, up 116% to 1.451 billion rupees, which tells you cost control genuinely worked this year. Profit before tax rose 24% to 1.689 billion. Here is the number that should make any strategy analyst pause. Though profit after tax actually fell 5% to 726 million rupees and return on equity dropped to 3.21%. So, while operating performance strengthened, bottom line returns to shareholders softened, likely a mix of tax movements and continued capital investment since cumulative capex jumped 35% this year to 8 billion rupees. The balance sheet, though, is genuinely conservative. Dilmah carries zero long-term debt and remains almost entirely equity financed. Total assets cost 28.9 billion rupees, up 7%. None of this happens without the people and the culture behind it, and Dilmah is unusually explicit about that connection. Dylan Fernando, Meryl Fernando's son, now serves as the chairman and chief executive and ties every major decision back to his father's founding principle that business must be a matter of human service. The MJF Charitable Foundation receives a minimum of 15% of the company's pre-tax profits directed toward education, healthcare, and plantation communities, a governance commitment, not just a donation line. On the workforce side, employee retention sits at 88.1% and training hours jumped over 400% this year, averaging 428 hours per employee alongside 83 internal promotions. This is a company using culture and people development as a deliberate strategic lever, not just an HR statistic. Before I wrap up, three forward-looking moves. One, accelerate digital transformation, deeper e-commerce and customer analytics, especially where premium positioning could command higher margins online. 2. Keep investing in climate resilient agriculture since tea yield is fundamentally a weather bet. 3. Keep expanding value added wellness lines, ready to drink, functional, immunity focused teas to capture the consumer shift already working in Dilmah's favor. So let's land the plane. 40 years ago, a small Sri Lankan family business bet that authenticity could beat scale, refusing to blend, discount, or compromise on quality. This year's numbers say that bet is still paying off. Double digit revenue growth, operating profit more than doubling, and a brand trusted enough to underwrite a serious expansion into hospitality and wellness. In conclusion, the 2024-25 integrated annual report demonstrates that Dilmah is much more than a successful tea company. It is an organization that has successfully integrated purpose, sustainability, innovation, and strategic management into a coherent business model. Throughout this review, we have seen how the company has built sustainable competitive advantage through premium quality, ethical leadership, operational excellence, and responsible corporate governance. Despite operating within an increasingly challenging global environment, Dilmah continues to demonstrate resilience through strong financial performance, disciplined strategic execution, and long-term stakeholder value creation. But here is what I want you to take away. Strategy is not judged by the parts that go right. It's judged by our company and it's the part that don't. The softer bottom line, the currency exposure, the RTD giant circling, that's the real test ahead for Dilmah, not the easy years behind it. That's Dilmah Ceylon Tea Company PLC, proof that in an industry built on commoditization, staying single origin stubbornly might just be the smartest strategy of all. I'm Abdul Malik and thanks for listening, and I'll see you on the next one.